Good afternoon and good morning, everyone. It's Ted Bader here, President with SIA Wealth, and thank you all for joining us once again on our weekly webinars. This is an interesting week because since the last webinar we had on last Wednesday, we've since gone into our green zone. So the funds that we run for BMO and any of our other mandates have become, over the last week, fully invested in equities again. So this is a very bullish signal for us on the equity market. And we're going to use this opportunity to talk briefly about the funds and what we've been allocating to. And then Jeremy is going to highlight exactly why we went green, what the market outlook is going forward, and what this means for you as our clients and investors as well. If there are any questions, we're going to address them at the end of the presentation. So just type in the questions in the question box, and we will answer. And we'll also have a replay available and a YouTube channel. So if you do have a minute, go to our YouTube channel and subscribe so you can get all the links and updates on what we're talking about. So next slide, please. One more. So we've been talking an awful lot about where these funds fit, where SIA fits in your book. We've had a lot of conversations with advisors, especially over the last week, that have quite emotional responses to us getting back in the market. I just want to highlight the value that a process-oriented, rules-based system like SIA can bring to this situation. The last 3 months has been an emotional roller coaster for most people, locking down the entire world, worrying about the health of our loved ones and family, trying to figure out what's happening with the markets, such a swift, quick drawdown and a rebound back up. It seems obvious as to what's going to happen next. And we've been told by a lot of advisors that it's clear that the markets are going to have another leg down, so they don't understand why we're necessarily going green. But the fact of the matter is we're looking at money flows, we're looking at price movement, we're running billions of comparison charts every single night. And as you look at some of these different slides, you'll see that what we were 100% sure of didn't necessarily end up playing out over the subsequent weeks or months or years. Now, is it the right idea to get back in the market today? That depends on your time frame. Does it look smart over the next week? Maybe. Does it look smart over the next month? Does it look smart over the next year? Does it look smart over the next 2 or 3 years? We're not in this for the short term. We are in this for the long term. And we are confident and comfortable in our system to play these longer term trends. It gets very complicated, as Jeremy will explain, when you have intervention to this level, but there is a consequence to all of this intervention. That's exactly what we're talking about. So if you look at a chart like this, 2008, it was a pretty severe, dramatic correction in the core equity positions is what we're looking at. Being able to move from Canadian to international to Europe to US is one of our strengths. If you go to the next slide, being able to move amongst the different explore sectors, going from emerging markets, currently getting significant weight into gold, even the small cap space. These tactical opportunities is exactly where SIA's strength is. It's not always going to be clear, but over time, you're going to be able to see exactly what that means. And on the final slide, it shows you just really where we add that value from going out of the markets and going back into the markets. It might not look like it makes any sense on a short-term basis, but again, we're trying to have that longer-term trend, and that's exactly why we take that emotion out of it. A lot of clients have been emotional, and a lot of clients have been appreciative of the system. And what we're trying to do is just give you another input, another type of information to take. We are not fundamental managers. We are not long-only managers. A lot of things have been mixed up over the last few weeks and months. So technical indicators don't respond as they normally would. Fundamentals don't make much sense. And we're trying to figure out how this works out. Taking our emotions out of this is probably one of the best things we can do. And that's what SIA brings to the table. So without further ado, I'm going to turn it to Paul Vendrinsky, who's going to talk a bit about our portfolios and where we've been allocated into, and then Jeremy's going to talk a bit more about the big picture and what that means for SIA and our clients. So Paul, over to you.
Thanks a lot, Ted, and thanks everybody for joining us. As Ted mentioned, the Green Equity Action Call change at the end of April there triggered a lot of changes in the 4 portfolios that have equity exposure. So I'm just going to go over exactly what happened after that date and what we moved into. We are coming out with the commentaries for all of the funds here very soon, which will go in a little bit more detail, but I just want to kind of give everyone an indicator of what we're buying. Before I get into the specifics, I wanted to put this slide up here. This is from SIACharts. If you're a subscriber, you've probably seen this before. This is the sector rankings. So what they've done is they've created equal weighted indices for the various sectors and subsectors. And we don't specifically look at this when placing, when designing our portfolios, but it does correlate very closely in that we're buying specific ETFs and individual stocks. But what you can see here, which correlates with what I'll show you in a second for a lot of the portfolios, what ranks high right now. 4 out of the 8 positions in the top are technology names. So this is something that's been strong in the computer software, the semiconductors, the internet, as well as certain hardware names. So you'll see that as far as some of our holdings in the various funds. Also, gold. The materials name had a large move up within these rankings over the last month, and you'll see that we've definitely taken a position or multiple positions in certain portfolios in that asset class. And the other thing that's been strong, as well as the technology, even from continuing from last year into now, has been the healthcare and drug sector. This time around, healthcare and the drug sectors are getting a lot of funding from both the international and federal governments because of the situation we're in. But it's a continuation of strength on these sectors. So we'll look at some of the specifics here. On the next slide, we'll have a first look at the BMO Tactical Global Asset Allocation ETF Fund. What I wanted to show here first is some of you may have remembered when the equity action call moved on the very start of March 6th, into that yellow zone. This triggered a big macro change to the overall portfolio where we shifted from a 60% weighting in equities to a 60% weighting in fixed income. With this recent move back into the green zone, this switched us back now. So we're now 60% looking at a focus of equity holdings and lowered the fixed income. And the bottom there shows you the allocation shifts. The next slide will show you some more specifics as far as the individual holdings. Again, this is our balanced fund. And at the bottom here gives you a snapshot as of what the portfolio looks like as of today. So the 40% fixed income is the same holdings that we hold within the standalone bond fund, and the various holdings, equity holdings on that 60% side now is on the individuals stock names as well as sector and broad-based ETFs. It's a little cleaner if we go to the next slide where we can just look just at the BMO Tactical Equity. So again, those are the same names in the balanced fund, but it gives you a easier view of what we've purchased. So we have a 25% allocation into 5 stocks. You can see them there. We have Amazon, Shopify, Franco-Nevada, United Health, and Danaher. So a very diversified section there. We own some tech, internet, diversified services, metals and mining play, as well as a healthcare position. You can see on the right-hand side this split. So we're evenly split between US, Canadian, international, and I should note here, we own that 25% individual stocks, but we're split for the rest of it, about 30-30, between sector ETFs and broad-based ETFs. The sector ETFs you can see here, US home construction, Canadian materials, we have Canadian oil and gas right now, biotech, US medical devices. The other half was the broad-based names. Based on the rules in the portfolio, we're buying from the top 2 asset classes. I believe Jeremy will be talking about this in a bit, but that includes international equities and cash. And this is where we've bought into those 2 sides. So we bought into the BMO European High Quality ETF, as well as the iShares All Country World Minimum Volatility. That represents the international side. As far as the cash weighting, we're continuing to hold the BMO Ultra Short Term US Bond ETF. Um, if, for instance, and we're getting calls on this, U.S. equities moved up, say, to second or even the first spot, this would give us the opportunity to move that 18% into an equity holding or potentially another international name. The next slide here will give you a snapshot right now what the BMO SIA Focus Canadian Equity Fund looks like. Again, this is a concentrated 15 stock strategy based on the Canadian universe of names. And what you'll see here is that currently have 3 energy names, 3 tech names, 3 gold names, 3 diversified services names, and then a single financial service, single consumer durable, and a single utility. So fairly diversified. And what should be noted is that still no exposure to the Canadian banks, where this might be seen as a potential hedge in case of a turn in the markets, that 30% or 20%, sorry, in gold might help there. If continued strength continues with the broad markets, that may potentially be a position or a sector that will slowly back out of. But as of now, these are the top ranked sectors as well as the top ranked relative names. And last but not least, the next slide is the BMO SIA Focus North American Equity Fund. So again, we're taking a basket of US stocks, a basket of Canadian stocks, currency adjusted from a Canadian perspective to put our money where the strongest names are. And similar to some of the sectors, as I mentioned earlier, that were strong prior to the equity action call going to red, we do have a healthy weighting in the technology side and in the healthcare side. The difference this time is our 20% allocation into the materials. So we have quite an array of companies here, similar to the Canadian focus. We're looking at the top ranked names, and we'll rotate based on what we see going forward. So that's a snapshot of these portfolios. I just wanted to give a quick summary on that. Our commentary should be coming out pretty soon now, but be free, feel free to give any of the sales guys a call or myself with any questions. And with that, I'll pass it back to Jeremy for a look on the market.
Thanks, Paul. Thanks everyone for taking time today. A very, very interesting week. I recorded an update on Thursday last week, but this will be our first full webinar since we went green. And if you haven't seen that update on Thursday, we'll cover off a lot of those points here. First and most important, as Paul and Ted have both mentioned, we've moved back into the green zone. This comes after a respectable rally in the cap-weighted benchmarks. But keep in mind that we use equal weight indexes for our measurements here. It's really just that over the last couple of weeks that we've seen strength in broad markets, and we see ourselves in the green zone right now. When we look at the asset class rankings from the update that I did on Thursday last week, we haven't had any change. We see international equity in the first position, cash in the second position, U.S. equity third, currency in fourth, Canadian equity remaining the weakest of the 3 equity classes in 5th position, commodities in 6th, and fixed income bonds in 7th position, which is a quite unique occurrence for market conditions as volatile as these. The first chart I want to highlight is we've been asked lots, have you ever seen this type of an equation before, especially having cash in the second asset class while we're in the green zone? This is an extremely rare event. We look back historically through our work, and the only other time where we see this in international equity was in the #1 position was in September of 2006, or just before September, August of 2006. We moved back into the green zone with international equity in the first position, cash in the second position, and I think there are some significant similarities between what was happening in 2006 and today. If we think back to that 2006 timeframe, it was shortly before that we had Fannie and Freddie out of the United States, their mortgage insurers, stop reporting financials. So at the time, I remember being very puzzled on why they were being allowed to not report their financials Well, it was simple. They were trying to solve the problem with the asset-backed paper and the mortgage bubble and the debt bubble and everything that was part of that 2008 crisis. That started back in 2006. What's important for us to note when we look at this relative to what we're seeing today is that it took 16 months for that problem to really come to fruition. So looking at today, we have the coronavirus that created a downturn in the markets, but really what the coronavirus highlighted was some of the underlying problems that were in the system. We had oversupply of crude in the marketplace, and certainly the production of energy was increasing at a dramatic rate. We had problems in the debt market. There was still downward pressure, tremendous debt out in the system. Lower interest rates were looking for that, but likely on the tail end of a long bull market in bonds. And now when we look at where we are today, it's not dissimilar that we've now, it looks like, at least come out of some of the coronavirus crisis. We'll see what happens as the economies open up, but now we're going to be left dealing with the economic fallback on that and some of the geopolitical issues that have been really, really highlighted through this process. So that's likely to take some time to work out. So it'll be interesting to see. I obviously cannot qualify at a high level that this is what we're going to see, but I think there are some similarities where the problem was seen, it was highlighted, and now we're going to see what central banks, governments, and how the markets react over the next year or so as they try to solve these longer term issues. So what's been helping, what got us back into the green zone? So I've listed a number of contributors to what has given us the cash flow back into equities versus alternative asset classes, such as commodities, currencies, bonds, and cash. And the first, and I think likely most important right now, is that global governments have an unprecedented and, more importantly, uncontested spending ability. So we've seen tremendous deficit spending coming out, checks to consumers, checks to businesses, checks to landlords, checks going out to pretty much anyone who needs it at this time, charities, et cetera, et cetera. We're seeing these deficits balloon, and for the most part, because of the COVID crisis, most of this spending, most of this these contributions back into the economy to keep it afloat are coming uncontested by opposition parties. So as long as the COVID-19 crisis keeps going, as long as there's isolation, it makes it much more difficult for anyone to put a finger on how it's going. So I know in Canada today we're going to start having some parliamentary sittings, very, very few attendees in that, and we should expect to hear some of that. But largely looking at how the structure is worldwide, governments still have free rein or largely a blank check to keep spending money to boost the economy, which is bullish for equities. The other area that is quite important to the measurement going back in the green zone is that global central banks also have unprecedented and uncontested spending abilities. They've been purchasing lots and lots of assets. They've lowered interest rates to near zero, mostly around the world. But I think what's key to it is that they've also started taking much, much riskier assets on their books than they have in previous crises. And for example, corporate bonds or junk bonds have been purchased up and are being purchased up by central banks around the world. This is a great opportunity for risk takers. What many may not have been aware of during the initial downturn of the COVID crisis was that bonds went largely no bid. They were quite a ways away from their intrinsic values, and especially in the junk bond market, those bids were not there. So risk takers, those money managers who are using higher risk corporate junk bond debt in their portfolios to get equity-like exposure, and we know who those all are out there in the bond market. We've seen this been going on for 3 or 4 years as bond managers strive to get returns out of their portfolios. Those risk takers now have the opportunity to sell some of those bonds at fair value back and potentially can reallocate to equities. The third contributor is really just the massive amount of issuance of debt that governments, provinces, states, and businesses are going to do post-COVID. We're going to have a situation where there is estimates that I've heard in the 9 trillion level globally that's going to be issued. So we're going to have too much supply of fixed income in the markets, And if we look at our asset class rankings, which are highlighted here on the right-hand side of the page, we can see bonds are in last place. So this is quite unique. You would expect to see in recovery timeframes that cash, commodities might be lower down on this list, but they're not. Currencies would be lower on this list, and bonds would be higher. That's not the case this time. The market is going to be oversaturated with fixed income. We're on the tail end, likely, of the most extensive bond market. I mean, this goes back to the early 80s when bonds started to get into their bull market phase, and now interest rates carrying around zero. So bonds are yielding very low returns, and there's going to be too much supply, which should hurt prices and ramp up yields. So holding these bonds may not be as attractive. So we can see potential reallocation from those people that were looking at a bond portfolio, maybe a 60-40. Now they go 70-30, 70% equity, 30% bonds, or an 80-20. We're going to see what we're looking at seeing is bonds being a victim and equities potentially being a contributor back with that money that's there. And then the fourth reason is it's an election year in the United States. And so this has traditionally been a very bullish year to be invested in equities. Escape 2008 when the crisis came into play there. But we've certainly got an incumbent who, through his presidency, has pointed at the stock market as a clear indication of his ability to govern. We shouldn't expect that to change going forward, and whatever tools he can use at his arsenal would be expected to come into play to help equity markets going forward. So getting on to some charts here, the first chart I want to highlight and focusing on international, which is at the top of the list. There's many names that are potentially unconventional names that are sitting at the higher end of the market. Reasons are they're probably been better equipped to handle the COVID crisis and to keep their economies rolling a little bit better. So we've got Taiwan here, but there's also New Zealand, which I highlighted in my update on Thursday, Switzerland, China. If you look on the reports at SIACharts, there's many sectors in China not dissimilar to the United States that are doing well, Japan and Israel. So we've got some other names that are out there. Looking at Taiwan, and most of the charts are not dissimilar to this. We're sitting right at resistance. That's a common theme that we've seen with the cap-weighted indexes that have done well. But we've got potential here for a move above that and potentially get into the $40 range, which is about a 10% increase in value. So we're seeing price objectives that are about 10 to 15% above where we're currently sitting here. And we have had a slight pullback over the last few days, which have helped the risk reward on many of these charts. The next chart I want to look at has really been the strongest North American benchmark, which is the NASDAQ Composite Index. So again, one of the driving forces for US to be sitting in the third position in our asset class rankings. It too is sitting near near-term resistance with a move above potentially giving it an opportunity to get near that 10,000 range. So again, you've got roughly 10, 12% potential upside on a risk-reward basis here, and we've got support nearby that's above 81.10. So another chart to look at, but significantly bullish, not dissimilar to what we saw with Taiwan, a very bullish chart after a strong downturn. Looking at Canada, which unfortunately ranks much lower in the 5th position of the asset class rankings. It too is close to resistance. It's about another box away from that. It has been one of the weaker major indices out there. If we're going to invest in Canada, as Paul Bendrinsky commented earlier, we're going to have to be very specific. He mentioned many sectors there. It's real Shopify on the technology side, but metals and mining, utilities, energy, diversified services. I think what's quite telling about where the strength is in Canada is it's not in the financials. The banking stocks have not ranked very well recently in this. So this is an area where I think it's important to continue to focus on very, very strong sectors. And looking at some of those sectors, I think it stands to reason, given the COVID crisis, health services has done very well, one of the top ranked sectors within our sector reports. We can see that it has moved within 4 boxes of its high in February. It did move through key resistance lately and still offers a strong risk reward. So there is potential here, and certainly with talks of COVID vaccines are out and treatments for COVID that can reduce the severity of COVID on there. Health services are going to continue to do well, and even just with the treatment and the supplies that are needed to keep us in this isolation period and keep the healthcare workers and other frontline workers safe, there's potential for strength there as well. Drugs, another sector obviously very strongly correlated to the COVID crisis, almost to its highs back in February here. A move above would be seen as a very bullish chart signal. We've seen resistance and sideways movement since the latter part of 2017 on the drug sector. So movement here would be bullish. We'll look for resistance to be taken out of that February level, which has been tested 3 or 4 times over the last few years. So another sector that we're looking strongly at. Internet obviously has done well again. It's been very, very successful during this downturn because of the ability, Netflix as an example, and online shopping has certainly seen a boon. The expectation is going forward that some of those consumer changes that have happened, those people that may not have adopted technology or internet as effectively as others will see the benefit of that. So again, we're close to resistance here with potentially 10, 12% till we get to resistance. You can see a higher chart point back in 2018. We wouldn't expect that to be a very strong resistance. It's really that near-term resistance that we see as the second level up that we'd be watching for. But again, a strong risk reward, another sector to be looking at. I think the last chart I believe I have for today is crude oil. We've seen some good strength come into this. I think this is material to the overall sentiment of being bullish for equities and bullish on economic activity going forward. We've seen some positive movement here. We've gone through a number of resistance levels recently. So this likely is really showing us that the storage issues that we saw, where we saw negative pricing last month on crude, have been resolved. The opening up of economies around the world is certainly going to have, I think, some strong effect on crude demand, and we expect that to continue, and likely even some more air travel could happen, but people might be more likely to hop in their cars this summer and do some local tourism rather than going outside their country. And then, of course, the supply cutbacks of OPEC, Russia, and the United States have certainly been in play now for a number of weeks. Those are likely coming into effect as well. So with that, we're glad to have you here. I think we're going to turn it back over to Ted Bader, who's going to read some of the questions that you may have had through this presentation.
Yeah, thanks, Jeremy, and thanks for that update. One of the questions that I've had a couple of times already is what are the factors, I guess, what it would take for us to go back into the yellow zone or even the red zone? I know it's not in absolute terms in terms of market movement up or down, but just kind of what would it take, or is there an expectation that could happen?
Yeah, anything is possible. There's a lot of things that as this crisis has happened, we've been able to take some time and look at the data and interpret it a little bit differently than we might have. And once you get past the emotional shock of having the economies largely shut down, but this government stimulus coming in and its effect now can be measured as well. So I think international and U.S. equity are clearly the two that we would want to see continue strength. So if we saw some weakness in U.S. equity or international equity moving down, Canadian equity is not contributing that much to a green equity action call. It's certainly a very small market, very narrow and focused at the best of times, even more narrowed than it traditionally has been. So we'd be watching on that. Bonds being ranked very low is helping the equity action call. Currency and cash are really the major threats. So I think looking at this and with the expectation that one of the major reasons why we've seen green equity action call with cash in second is that the bond market has been under tremendous pressure. We can see it here, and that some of the proceeds of people selling that off have gone into equity. So if that were to change, but again, I don't have a high expectation of that given how much government intervention is happening in that bond market, suggesting that that still remains a weak area.
Is there anything, I know this is a difficult question to answer, but I've had this a couple times. What happens if the government stopped writing blank checks? Is that even a possibility? And if so, how quickly are we able to respond to that?
Well, it's certainly a question that I've posed to myself on a number of occasions. I think we're in the unique situation where it's it's MAD. It's mutually assured destruction. So if there is a chink taken out of one of the major, talking about Japan, Europe, and the United States largely, those are the three major economies that are carrying us through this. If they were all of a sudden not able to support their economies during this time frame, I think it would topple the cards. So I don't see any benefit to that. Opposition parties that interfered or found some ways to stop that, are risking destruction upon the economy, which is going to be bad for them in the future too. So I think near term there is that. We're not playing the house of or musical chairs here right now. It is mutual assured destruction if one of these governments lets off at this time, or central banks lets off at this time. So I don't see that as a near threat. Is it possible? Absolutely, anything's possible in a crisis. But what the catalyst for that would be, I can't see.
Here's a quick question. Sometimes we assume that a lot of people understand the point and figure charts when we're talking about this, but a lot of people on this webinar aren't familiar. So one of the questions are, what do you mean when you talk about the support and resistance? Could you do that quickly, just to give us a kind of an update for some people who might not understand what that is?
Yeah, and this is more just my background as being a point and figure technician, just highlighting out the risk reward in these equations. So where you see that first level of support here on the Taiwan chart above 3405 is our support level. When you're in an S-max of 6 and you're in a green equity action call, you should look at the second level of resistance as your price objective when assessing that. So you're generally looking for a 2-to-1 relationship. So what I'm generally trying to highlight here is that the risk reward is moderately good right now. So that gives us an opportunity for upside in the market and some price objective, because it's very, very difficult for someone to come into a market now thinking that maybe they've missed the run. Maybe there's tremendous risk. What is my potential upside versus what is my risk? So just trying to highlight that on some of the key charts in the international US and Canadian marketplace to give you some idea, because they tend to look very, very similar, especially broad-based investments such as exchange traded funds tend to get very, very similar looking. So you can sort of see this almost 2-to-1 risk reward, which is what we're looking for when we want to make an investment.
Okay. Next couple questions are for Paul Vendrinsky because they relate to the portfolios. So international is the #1 asset class. However, in some of the funds, why don't we have a larger weight in international as opposed to US and Canada? I guess that relates to the tactical asset allocation fund. Paul, do you want to talk about that briefly?
Sure. Yeah. Thanks, Ted. Yeah, and that's a good question. The thing is that from a bigger point of view, we have the ability to buy into anything that we're seeing strength. So as an asset class, as international, there's a lot in there. So that asset class is going to also include stuff like the oils that have rebounded 50+% since their April low, or metals and mining that have moved up that. So we're not specifically always focusing on that one asset class in particular, but in a broad set of opportunities, whether it's ETFs or individual stocks. Within the asset allocation fund, there's only a small portion where we're locked into looking at those two other asset classes. So that's the quick answer on why we don't own more international. But I can combine this probably with some other questions we've been getting too, as far as how we're able to pinpoint into sectors that seem to be within a weaker asset class. Like, for example, we a lot of times will look at an individual position and see it as more of a diamond in the rough compared to a weaker overall sector. I'll give you an example. Last year, Canadian equities, and even right now, Canadian equities as an overall asset class remains fairly low, but something like Shopify was one of the best producing or best performing stocks on the planet. So there we can find some strength. And we're also seeing this within, say, the Canadian fund right now, where we're seeing, as I mentioned, a big rebound in certain oil names, but even within the overall energy sector, there's still, again, diamonds in the rough, stuff that are outperforming those. So when we're seeing those large percentage gains, it has allowed us to pick up some individual oil names that we own in that portfolio when the trend of the overall sector could be showing weakness. Sorry, go ahead.
No, I guess that's the point, right? Because if Canada's ranked low, there still could be strong sectors in Canada. And even if some sectors rank low or seem to have been beaten up, there could still be some individual positions that we might end up owning, because we look at, individual stock reports, individual sector reports, and broad-based reports as well, correct?
Exactly. And, I can even expand that into the bond. The bond asset class, as Jeremy just showed, is at the bottom of the list. But again, it doesn't mean all bonds are bad. The bond asset class is going to include, outside of investment grade vehicles, high yield, junk bonds, preferreds possibly. So rather than, somebody asking, why should I own any bonds when it is so low? Again, there's some stuff that is doing okay. If you look at our bond portfolio as of now, we switched what we had last year and the start of this year away from corporate bonds into a little bit more safety as far as the treasury bonds. So it still is in an investment grade portfolio, but doesn't hold certain things that other bond portfolios that we know our clients are holding own, such as high yield, emerging debt, and stuff like that. And another example too would be the golds when commodities as a whole is low. Well, golds are only a certain portion of a commodity asset class, and the gold stocks, whether it's a flight to safety, whatever the reason is, has been outperforming a lot of other stuff within the commodity space. So again, outperforming stuff within a broader sector.
Okay. Actually, that relates to another question. Jeremy, do you have anything that talks about gold technicals, given the increase in the ranking for mining and metals? It's a good question because we do have an allocation to gold now. So do we have anything on that?
Yeah, I didn't pull up anything specifically on the precious metal side. There was, I did comment on that on my Thursday update last week when we moved into the green zone. But it's certainly very, very strong, big move up there. Obviously, precious metals has done very well, but also the materials side of it has done well as in the last number of weeks as well. So those hard commodities have done better. Copper, which I love to use as a barometer for economic growth, continues to inch forward. So there is certainly strength and remains in there. I would expect as this rally continues that gold may hit a bit of a ceiling. That I'm talking more about the commodity than I am talking the underlying stocks. There is very strong resistance as it is clearly used in some currency activity by central banks and investors around the world. So that can create some artificial market for it outside of the traditional supply demand. But the individual securities all remain strong, and that is one of the areas, if you're investing in Canada, that's one of the great things about our Canadian focused product is that we're able to get into those sectors that are participating, whereas many asset managers don't have that ability, and they're more just inside or outside the closet index seeking their return. So we can get quite a ways outside of the conventional asset allocation with industrials, materials, energy, all at the top here. So they've done very well.
Okay, thanks. Paul, one of the questions was, do we need 5 sectors? If we're buying 15 stocks, do we need all 5 sectors represented, or can it be less? Are we able to have, what type of concentration do we have?
I assume that's talking about the sector ETFs within the equity and the asset allocation fund.
I think it's relating to the individual stocks. So out of 15 names, are we having 3 stocks per sector for a total of 5 sectors?
Okay, well, we do have flexibility. It could be 15 individual stocks in 15 separate sectors. We do have restrictions on maximums, but generally speaking, we try to hold less than that 25% for a GICS level or a GICS level 2 sector. If that answers the question.
Okay, so yeah, so 5 is probably the minimum. So okay, and Jeremy, one more question from you. Is it possible to have a retest of the March lows and still stay in the green zone?
I would expect no. We would expect at a minimum to see yellow zone and likely a red zone if we're going to go back into that. So if that situation for us to hit those lows again, we would expect that the efforts of central banks and governments around the world are failing. And that would be obviously, there would be very few tools left, I think, in their arsenal to gain support there. So it's not something that technically I see in the near future, or even fundamentally, given the amount of support that's in the marketplace. Is it impossible? Absolutely not. It could certainly happen. There's always reasons for a market that it could go down, but the weight generally is carrying to the upside based on some of those talking points that I had earlier.
Okay, so we're coming up about 45 minutes since we started. I don't want to keep anyone too much longer, so if there's anyone whose questions have not been answered, we will reach out and respond to you. If there's anyone who still have more questions afterwards, please reach out to us and we will more than happy respond. In the meantime, thank you for attending. Thank you for paying attention. Like I said at the beginning, an emotional investing decision might make you feel better in the short term, but we're looking at a bit more of a long term, and the process that we're providing is our intention is to pay off in the long term. So for me and Paul, we're going to wrap it up. Jeremy, if you want to just wrap it up, and then we'll stop the webinar.
Yeah, no, I think that's everything. We really appreciate your time, and always keep in mind that you can reach out to myself and the remainder of the team with questions at any time. We're happy to have a conversation. We have been doing client presentations for our big supporters at SIA Wealth, and certainly we've seen some great success with those presentations, getting directly talking to your clients and giving them an understanding of what's happening in the marketplace. So with that, we'll close it off, and we'll talk to you soon.